Street just had its worst day in months. $500 billion gone in one afternoon. And the Fed didn't even raise rates. This is the Milton Brief for Thursday, June 18th. On June 17, 2026, the headlines were blunt. The Dow tumbled 500 points after Fed officials hinted that interest rates might actually go up later this year. The damage was broad. The Dow closed down nearly 1%. The S&P 500 fell 1.2%, and the tech-heavy Nasdaq dropped 1.3%. The trigger came from inside this building, the Federal Reserve. It was Kevin Warsh's very first meeting as chair, and the Fed chose to leave interest rates exactly where they were. So why did markets panic over a decision to do nothing? The answer is the dot plot. The Fed's median forecast for year-end rates jumped from 3.4% in March to 3.8% now. That small shift carries a big message. A higher forecast means policymakers now expect to raise rates at least once more in 2026 to keep inflation in check. Traders repriced almost instantly. The odds of a rate hike this year shot up from under 60% to 84% in a single afternoon. Trading floor, that meant selling. When borrowing gets more expensive, future profits are worth less today, and the high-flying growth stocks feel it first. You could see the fear in the bond market. The 2-year Treasury yield leapt from 4.05 to 4.21%, while the 10-year pushed up to 4.49. Big tech led the slide. Microsoft fell almost 4%, Amazon 3.5%, and Nvidia slipped over 1%. The lone bright spot, furniture maker La-Z-Boy, surged nearly 15% on strong earnings. Wall Street was quick to react. Economist Claudia Sama said the new forecast was much more hawkish than investors had been expecting heading into the meeting. Here's the bottom line. Higher rates make mortgages, car loans, and credit cards more expensive, but they are the Fed's main tool to slow down rising prices. And it's a global story. Markets from Hong Kong to Europe moved on the news, because the world's borrowing costs still take their cue from the US Federal Reserve. If this helped, subscribe to the Milton Brief, and we'll keep you ahead of the markets.